Picture this. You're standing in downtown San Francisco staring up at the Salesforce Tower. 61 floors, 1.4 million square feet, one of the most expensive buildings ever constructed in the city. The lights are off on 20 floors, not because of a power outage, because nobody works there anymore. Walk 2 blocks, 3 more towers, same story. Vacancy rates pushing 28%. These aren't struggling startups. These are Fortune 500 headquarters, and they're handing back the keys. This is the commercial real estate crisis, the silent financial hurricane tearing through the American economy, while everyone's distracted by the stock market hitting new highs. Here's what they don't tell you. This isn't just a landlord problem. This is a banking system stress test, and a lot of banks are about to fail it. In 2025 alone, $957 billion in commercial real estate debt matured across the United States. That's nearly triple the 20-year average of $350 billion annually. Triple. But 2025 was just the opening act. In 2026, another $936 billion comes due. Then in 2027, the real nightmare hits. $1.26 trillion in a single year. Added up. Over 3 years, more than $3 trillion in commercial real estate loans need to be refinanced or restructured. That's not a maturity wall. That's a maturity tidal wave. And here's the trap they built for themselves. Most of these loans were originated between 2018 and 2022 when interest rates were near historic lows. The average commercial mortgage rate at origination, 3.9%. Today, 6.6%. That's a 270 basis point spread. Borrowers trying to refinance today face interest costs that are 70% higher than when they took out the original loan. Think about the math. You own an office building. You financed it at sub 4% rates. Your monthly debt service was manageable. Your tenants covered the payments with room to spare. Now your loan matures. You go to refinance. The new rate is 6.6%. Your debt service payments just increased by 75 to 100%. Your rental income didn't double. Your occupancy didn't double. In fact, if you're an office landlord, your occupancy probably dropped by 20 to 30%. The building doesn't cash flow anymore. You can't refinance, you can't sell, nobody's buying at the price you need. So you do what hundreds of other landlords are doing right now. You hand back the keys, the banks aren't stupid, they know what's coming, so they've developed a coping mechanism that Wall Street calls extend and pretend. Here's how it works. Your loan matures, you can't refinance at market rates. So instead of forcing you into default, the bank agrees to extend the maturity date. Push it out another year, maybe 2. Kick the can down the road. In the third quarter of 2025 alone, lenders modified $11.2 billion in commercial real estate loans. 67% of those modifications, maturity date extensions. By the end of 2025, an estimated $600 billion in loans that were supposed to mature that year got extended into future years. Think about what that means. The $957 billion that supposedly matured in 2025, a massive chunk just got pushed to 2026 and 2027, stacking on top of the debt already scheduled to mature those years. They're not solving the problem, they're compressing it, making it denser, more explosive. The Federal Reserve has a term for this: credit misallocation and a buildup of financial fragility. Translation: banks are pretending their loans are fine when they're not, because writing them off would wipe out their capital. So they extend the maturity, keep the loan listed as performing on their books, and pray that something, anything, improves before the next maturity date. Here's the part people miss. This strategy has a shelf life. You can only extend a loan so many times before regulators step in and say, "This is a zombie loan, mark it down." And when that happens, the bank has to recognize the loss. For some banks, those losses are going to be catastrophic. Let's zoom in on the epicenter: office buildings. National office vacancy rate as of the end of 2025, 20.5%. That's a national average, which means in the worst markets, it's far worse. Austin, Texas, 27% vacant. Seattle, 27% vacant. San Francisco, 26% vacant. Even markets that are supposed to be resilient, Phoenix, Washington, D.C., are sitting at 17 to 18% vacancy. Pre-pandemic normal was about 12%. Anything above 15% is considered distressed. We're now at 20.5% nationally, with major metros pushing 30%. This isn't just about empty desks. This is about a structural shift in how Americans work. that office landlords are pretending isn't permanent. Remote work isn't a fad. Hybrid work isn't temporary. Companies have realised they don't need 100,000 square feet when 40,000 will do. They don't need expensive downtown towers when suburban flex space costs half as much. And even among companies bringing people back to the office, there's a brutal bifurcation happening. Class A buildings, the new, shiny, amenity-rich towers with rooftop terraces and Peloton studios, are doing fine. Occupancy is actually rising in those properties. Class B and Class C buildings, the aging 1970s and 1980s towers, with fluorescent lighting and no air conditioning upgrades, are being abandoned. In Manhattan's central business district, 75 million square feet of office space is currently available for lease. That's 15% of all office inventory in the most expensive real estate market in the country. And here's the kicker. Roughly the same amount, 75 million square feet, is sitting completely vacant, not even listed, just empty. The best buildings are fine. Everything else is becoming a zombie asset. Now let's talk about what happens when landlords can't pay. CMBS, commercial mortgage-backed securities, are basically the office loan equivalent of the subprime mortgage bonds that blew up the economy in 2008. Banks originate commercial real estate loans, bundle them into securities, and sell them to investors. As of December 2025, the overall CMBS delinquency rate hit 7.3%. But for office CMBS specifically, 11.31%. More than 11% of office loans packaged into CMBS are currently delinquent. You know what the office CMBS delinquency rate was at the peak of the 2008 financial crisis? 10.7%. We are now worse than the 2008 financial crisis for office debt, and we're not even at the peak of the maturity wall yet. Office CMBS delinquencies stood at just 1.6% in December 2022. In 3 years, they've exploded to over 11%. This is what a sector in freefall looks like. Distressed commercial real estate sales, buildings being sold at deep discounts because the owner is in financial distress, hit $25.44 billion in the first 3 quarters of 2025. That's a 5% increase from 2024. In December 2025 alone, $1.3 billion in CMBS loans were newly added to the distress rate. 40% of that, $524 million, involved imminent or actual maturity default. Translation: the loan matured, the borrower couldn't refinance, the building went into default. This is the maturity wall in action, and it's only going to accelerate. At this point, some of you are thinking, why don't they just convert the empty office buildings into apartments? We have a housing shortage. Problem solved. Great idea. Except it's structurally, financially, and legally almost impossible for the vast majority of buildings. Problem number 1, floor plate depth. Office buildings from the 1970s and 1980s were designed with deep floor plates. You could have people working in cubicles 60 feet from the nearest window, because office workers don't need natural light to function. Residential building codes, they require bedrooms to have windows. Natural light is mandatory, so if you've got a building with a 150-foot wide floor plate, you physically cannot convert the interior space into legal bedrooms. There's no access to windows. The solution: cut massive atriums through the middle of the building, remove entire sections of floor space, rebuild the structural core. We're not talking about a renovation, we're talking about gutting the building down to the skeleton and rebuilding it from the inside out. Problem number 2, plumbing and mechanical systems. Office buildings have sparse plumbing, a few bathrooms per floor, maybe a break room, that's it. Residential buildings need full kitchens and bathrooms in every unit. That means running new piping vertically through the entire building, threading it around structural beams, HVAC ducts, and electrical systems. You know what happens when you start cutting holes through 40-year-old concrete slabs to install drain pipes? You find asbestos. You find structural issues. You find problems that weren't in the original budget. Industry veterans now build 10% contractor contingencies into conversion budgets just to account for the inevitable cost overruns. Problem number 3, zoning and legal barriers. Even if you can physically convert the building, you've got to get zoning approval to change the use from commercial to residential. Depending on the city, that can take months or years. In some cases, existing office leases contain provisions that prohibit residential conversion. The landlord legally cannot convert while tenants are still occupying the building. So you've got to buy out the remaining tenants, negotiate early lease terminations, pay cash for keys deals, all of which adds millions to the project cost. Problem number 4, the financial impossibility. Let's say you clear all those hurdles. You've got the zoning approval, you've got the structural plans, you're ready to convert. Here's the final problem. The math doesn't work. A full gut renovation of a major office building into residential units costs $200 to $400 per square foot. For a 500,000 square foot building, that's $100 to $200 million in construction costs alone. Construction financing right now, 10 to 15% interest rates. You're going to spend $150 million converting a building that's worth $50 million as an office property, hoping it'll be worth $250 million as apartments, in a market where multifamily rents are flat or declining. Unless you're in Manhattan or a handful of other high-demand markets, the post-conversion value doesn't justify the investment. And here's the brutal reality. The easy conversions, buildings with smaller floor plates, better locations, supportive zoning, are already being worked on. What's left are the hardest, most expensive, least economically viable projects. In 2025, developers completed 68 office-to-residential conversions, totaling 12.8 million square feet. Sounds impressive, right? The national office inventory is over 1 billion square feet. At the current pace of conversions, it would take 80 years to absorb the surplus. Conversions aren't the solution. They're a band-aid on a bullet wound. Now let's talk about who's holding the bag on all this debt. It's not the big banks. JP Morgan, Bank of America, Wells Fargo. They've got commercial real estate exposure, but it's diversified across their massive balance sheets. They'll take losses, but they'll survive. The real vulnerability is in regional and community banks. Small banks with assets between $0 and $10 billion have 48.2% of their total loan portfolios tied to commercial real estate. Nearly half of their loans are commercial real estate. By contrast, banks with over $100 billion in assets have only 13.2% exposure to commercial real estate. The regulatory guideline for safe CRE concentration is 300% of Common Equity Tier 1 capital. Small regional banks right now are sitting at 366%. They're over the limit by more than 20%. 55% of the 104 banks analysed in a recent study exceed the 300% threshold. And here's the part that should terrify you. New York Community Bancorp, one of the largest regional banks in the country, has a CRE to CET1 ratio of 617%. 617%. That bank is essentially a commercial real estate investment fund pretending to be a bank. Now add another layer of risk, unrealized securities losses. When interest rates spiked in 2022-2023, the bonds that banks bought during the low-rate era lost value. Those losses are sitting on bank balance sheets as unrealized, meaning they haven't been sold yet, so the loss isn't officially recognized. As of mid-2025, 185 banks have unrealized securities losses that exceed their common equity. Translation: if they were forced to sell those bonds, they'd be insolvent. Now combine that with commercial real estate losses. Analysis suggests that if commercial real estate losses reach 8% of portfolio value, which is entirely plausible given current delinquency rates, 278 banks would face capital adequacy concerns. We're not talking about a handful of banks. We're talking about nearly 300 institutions. This is a regional banking crisis waiting to happen. There's a theory floating around called the urban doom loop. It goes like this. Office property values collapse. Cities collect less property tax revenue. With less revenue, they cut services, police, sanitation, infrastructure maintenance. As services decline, more businesses leave. Property values fall further. The loop accelerates. It's a compelling narrative, and in some cities, it might even be true. But here's what the data actually shows. In New York City, one of the cities supposedly most vulnerable to the doom loop, office properties represent a meaningful but not dominant share of the tax base. Even under pessimistic scenarios modeling significant downtown property value declines, the impact on the city's overall fiscal position is manageable. Why? Because New York's tax base is diversified. Residential real estate, retail, industrial properties, outer borough assets, all of that cushions the blow from downtown office losses. Cities with growing populations generate 62% of all property tax revenue and 63% of sales tax revenue nationally. They maintain higher reserves, healthier budgets, and more resilient tax bases. Cities with declining populations. They were already in trouble before the office crisis hit. The doom loop isn't inevitable. It's a function of whether your city was already dying. If your city is growing, attracting residents, diversifying its economy, you'll take a hit, but you'll survive. If your city was already losing population, hemorrhaging businesses, and dependent on a single downtown core for tax revenue, yeah, you're in trouble. The office crisis is an accelerant, not the root cause. Now, some optimists will point to recent data and say, look, the market is recovering. And they're not entirely wrong. After 12 straight quarters of negative absorption, meaning more space became vacant than was leased, the US office market posted positive net absorption in the final 6 months of 2025, plus 2.5 million square feet. The strongest back-to-back quarterly performance since COVID. Sublease inventory, the space companies were desperately trying to offload, declined by 17.5 million square feet in 2025, down 14% year over year. Construction of new office space has cratered. Only 4 million square feet delivered in the fourth quarter of 2025, the lowest quarterly total since 2012. So yes, the market is stabilizing. But stabilizing at what level? National vacancy is still 20.5%. That's not recovery. That's just less bad than it was. Class A buildings are recovering. Occupancy is rising. Landlords are signing new leases. Class B and C buildings? Still dying. The recovery is a K-shaped recovery. The top tier is fine. Everything else is being left behind. And here's the critical question nobody wants to ask. What if remote work is permanent? What if 20% vacancy is the new normal? Because if that's true, then we're not in a temporary down cycle. We're in a permanent structural adjustment. And that means the office sector isn't going to recover to pre-pandemic levels. It's going to stabilize at a smaller, higher quality footprint, which means all that Class B and Class C inventory is never coming back. So here's where we are. $1.5 trillion in commercial real estate debt is maturing over the next 2 years. Office vacancy is at 20.5% nationally, with major metros pushing 30%. Delinquencies are higher than the 2008 financial crisis. Regional banks are overexposed and undercapitalized. Conversions can't happen fast enough to matter. The maturity wall is becoming a maturity avalanche, and the critical question is, what breaks first? Option A. Interest rates drop dramatically. Refinancing becomes viable. The crisis dissipates. Probability? Low. The Fed has made it clear they're not cutting aggressively unless the economy crashes. Option B. Property values stabilize at new lower levels. Buyers step in. Distressed sales clear the market. Probability? Moderate. This is the muddle-through scenario. Painful, but manageable. Option C. Defaults accelerate. Regional banks start failing. Credit markets freeze. The crisis goes systemic. Probability? Higher than anyone wants to admit. The next 18 to 24 months will decide which path we take. If the extend and pretend strategy holds, if lenders keep modifying loans, if property owners can hang on until conditions improve, maybe we avoid catastrophe. But if the maturity wave hits and lenders run out of patience, if regulators force banks to recognize losses, if just a handful of regional banks fail and trigger a credit panic, we're looking at a second wave financial crisis, not like 2008. Different structure, different players, different mechanics. But the outcome could be just as severe. The commercial real estate crisis is not a prediction. It's happening right now. The empty office towers, the surging delinquencies, the extend and pretend accounting, the overexposed regional banks, this is all documented, measurable, undeniable. Every major real estate bubble in history, the savings and loan crisis, the 2008 subprime meltdown, the Japanese asset bubble, followed the same sequence. Aggressive lending at low rates, asset prices inflating beyond fundamentals, a rate shock that makes refinancing impossible, extend and pretend until the extensions run out, then collapse. We are in stage 3 of that cycle right now. The extensions are running out. What happens next depends on how fast the maturity wave hits and how many banks are holding the bag when it does. This isn't financial nihilism, this is pattern recognition, and the pattern says we're not done yet. If you made it this far, you're part of a very small group of people who actually understand what's coming. Subscribe, hit the bell. The next video breaks down exactly which banks are most vulnerable and what happens if they fail. Leave a comment. Would you buy a distressed office building right now if you had the capital? Or is this a falling knife you wouldn't touch? Stay safe, stay smart. And for God's sake, if you're a regional bank depositor, check your bank's CRE exposure. Don't get caught holding the bag.